Hi, everyone. Welcome to the AGI Podcast. And today, I'm really honored to have Haseeb, which is one of the OG in the space of crypto blockchain and the managing partner of Dragonfly, come here. And he's probably one of the most famous investors in the space for a very long time. And also, I would say probably one of the most interesting panelists on a lot of the crypto events. He has most sharp and sometimes cynical views, so I think it's going to be a super fun episode. Yeah,
Okay.
I'll let
Thanks for
Haseeb
having me, Bill.
introduce him from a more interesting angle.
Yeah. So thanks for having me. So I'm Haseeb, managing partner of Dragonfly. Dragonfly, we're a $4 billion crypto fund. We invest in early stage projects from seed stage all the way up to Series A, Series B, and Series C and beyond. Investors in a lot of stuff that is, especially in this last cycle, has been very instrumental. So we're big investors into Athena, into Monad, Mega ETH, Polymarket, Kaito, many of the protocols that you probably know and love in the crypto space, we've been involved with at some point. And I spend a lot of my time thinking about some of the microstructure, minutia, some of the stuff happening at the frontier of things like crypto AI, which I know you spend a lot of your time on, Bill. That's where I spend most of my brain power. So that's me.
Yeah. Okay. So a brief introduction about myself, so that I think this podcast is more tailored towards like kind of really deep down into the DeFi and deep down into like perp DEX and yield bearing stablecoin. So from that angle, I was a Stanford Math PhD. I have been doing crypto for the last 10 years since the early Bitcoin days, and have been also like a fund manager managing $1 billion in Millennium for like quant equity books. And over the last 3 years, have been doing AI startup. And actually, recently we are launching a product called AI USD, which is powered by my AI startup, Generative Alpha, that has basically trading around $1 trillion every year on Binance already. So basically, it's like a high frequency trading firm that trades a sizable amount of like a funding rate arb strategy. And now we are turning the funding rate arb strategy into a high APY yield bearing stablecoin, but we are not really doing it the same way as the popular Ethena USD, where it's like an actual like DeFi coin that have its own liquidity pool. We are doing it more like a virtual layer where we like very tightly packed into USDT, so that like we want to like avoid say like those liquidity looping for like leveraged lending to get higher yield. We want to avoid problems like some of the Binance DPEGs that we went through, and also we want to actually make it usable as like the money for AGI in the future. But in the short term, basically personalize AI agent that user can talk to their AI agents like ChatGPT and say, wait, I want to buy this on this platform. I want to buy that on that platform. I want to stake it 3 days later when the price dropped 20%. And we basically turn out this simple description into like executable strategies and then move the money for the user. So kind of like your personal execution trader plus wealth managers at hand. Yeah. So with that introduction, let's get into the weeds. So
Yeah,
I think for the audience, as background information, after Trump's famous tweets about being angry about China, there is a massive like collapse on both the stock market and crypto market on Friday, and that triggers set a big liquidation event in the whole crypto world over the weekend. And maybe like Haseeb, can you tell us about your views about what actually happened and what are the interesting part and what are the lessons?
Yeah. So what went down? So this was a couple Fridays ago now. You had Trump putting out this announcement that he was going to basically shut down trade talks as well as levy massive tariff increases once again against China. And this happened at a Friday evening. So I think it was like roughly 4 p.m. Eastern. So markets were just about to close. You saw markets, the TradFi markets leg down, but crypto markets, of course, trade 24/7, and they trade over the weekends. And so there was really no way for the market to express its view about what was going on macro-wise and in terms of risk assets, except through the crypto market. And so this is one of the things that I think Joe Weisenthal from Bloomberg has described this, that in many ways the core innovation of crypto is it allows the market to express itself on weekends. And this is kind of really what happened in spades, is that to the extent that you want to raise liquidity and you want to just express panic, the crypto markets allow you to do that. Now, because of the timing of this, right? Again, there was very little time for traditional markets to digest what was going on with these tariffs, and there was a lot of uncertainty taking place around that time. But because of the speed and ferocity of the liquidations that took place, you saw crazy price movements and insane amounts of trading volume that basically took down most of the major exchanges. So Binance, of course, the biggest exchange in the world, they basically had their APIs shut down, I believe, for over an hour. And that the API shutdown also meant that it was impossible for assets to come in and out. Anybody who was API trading basically had total instability, inability to actually move inventory unless you're click trading effectively. And it also caused a number of massive depegs. So there are three assets that depegged on Binance. The first one, of course, was USTE. The second was there's BN Sol, and I think it was called WBETH, which are these Binance staking tokens that correspond to Solana and to Ether. They also massively depegged from, normally they should be 1-to-1. Now Binance sort of stood alone in that the other major trading venue, WBETH and BN Sol, they don't trade anywhere else. But of course, USDE is a massively traded asset. That's the stablecoin behind Athena, or the synthetic dollar rather. And USDE depegged on Binance to something like 68 cents, I believe. It came all the way down. If you look across venues, though, in DeFi, USDE basically stayed entirely at $1, and most of USDE liquidity is on DeFi. And then if you looked on Bybit, Bybit had some instability, but wasn't nearly as bad as Binance. And Bybit, it legged down to about 95 cents for, I think it was about 5 minutes, and then came back up to $1 pretty quickly. Binance, it was just total chaos for over an hour that you saw on Binance. So Binance, of course, being the biggest venue for this, you saw other huge dislocations. You saw, I think Atom wicked down to 1 cent. Normally it trades at like, I don't know, a few bucks. It wicked down like 99.9% for a single moment. You had a bunch of altcoins that went down 70%, 60 to 70 for many, many assets. They did recover after the craziness and the instability subsided. But the other thing, of course, that happened across many venues is ADL. ADL stands for auto deleveraging. This basically is an automated system that takes place on almost every perpetual swap exchange. And what happens in ADL is that basically if you cannot liquidate the order book in an orderly way, you cannot get people on the other side to come in. So normally what happens when a market becomes very imbalanced, there's many, many more shorts than there are longs. Then what you do is you jack up the funding rate, right? So you say the funding rate is the carrot to bring people into the market to balance out the market. Because, Perps, they're a zero-sum game. Somebody's long, somebody else has to be short. Somebody's short, somebody else has to be long. And if you're entering into the market, somebody has to come take the other side. Otherwise, the market is imbalanced and there's no one to pay you out if you win. So the funding rates blow out anytime you have these very one-sided market movements. And if nobody comes in, if it doesn't matter how big the funding rate is, nobody wants to be long when the market is melting down, then what happens is this other system triggers called ADL. And in ADL, essentially what happens is that all the positions in a particular market are ordered. And by some algorithm, different ADL mechanisms do it differently. By some algorithm, usually the people with the most leverage and the most P&L, so the people who are the biggest winners, they get kicked out of the system. They get forcibly closed. Their positions is basically, hey, you made too much money, go home, you're done, you're no longer long this asset. And so you had ADLs triggering all over the industry and across many exchanges, many of which, of course, are also the DeFi perp exchanges. Almost all of them also triggered ADLs. And because of this, ADL is very, very disorderly for markets. Now, it's not because of people don't get their P&L. They do get their P&L normally in an ADL, but the problem is that your positions are now gone. And that means if you were hedged, or if you were you're long here, you're short here on two different exchanges, if you get ADL'd, you're now naked long or naked short, which means that your risk allocation has been totally thrown out of whack. And so you had a lot of people who all of a sudden, they got liquidated when they thought that they were hedged. And their liquidation was not just like, oh, okay, you're liquidated, but it doesn't matter because you're hedged. You got liquidated and you're no longer hedged. And so you might have massively gone down, or obviously some people also massively went up. But it was an extremely disorderly day of trading, single largest day of liquidations in crypto history. And you had a huge amount of collateral damage that took place from all of this disorderly kind of market destruction that took place. So in response to all of that, Binance came out and ended up refunding people almost $300 million, as well as a subsequent, I think they airdropped another like $400 million that they gave to people who lost money in the BNB ecosystem. And so huge amounts of refunds went out. Of course, a lot of people lost money in ways they shouldn't have. So on the whole, it was a very chaotic day and a big lesson for everybody in crypto and DeFi about what happens when markets go this topsy-turvy.
Yeah. This is a really interesting day that actually I went up in the morning and I saw, oh, this is actually a crazy day. Let me look at all my books and also look at how the strategy is going. And turns out, I think our risk management is pretty good. We basically believe, okay, in this day, we shouldn't run any like future related like funding rate ARB strategy. So we liquidated everything, and even like our proper kind of like positions, everything, even like some of my stock positions have like kind of like overnight trading capability, like everything is like a liquidated to cash. So I was like pretty happy that
Nice.
our risk management system worked. But then I look at further, the first thing I noticed is USDE gets too close to 0.6, where it's kind of a surprise that synthetic dollar that is around like a $10 billion AUM get to like such deep hack on like Binance. So I spent a lot of time digging what's going on and like how to avoid this, since we basically are about to launch a similar business. Of course, we don't have a like real body like a DeFi token called USDE that it basically have less of the risk, but still I truly want to understand. So I guess there are a lot of discussion about what actually happened, but can you go deep dive a little bit, like what are the lessons from this thing, and how do you see the next time we can get it better?
So I'm happy to talk about the USDE episode. So I wrote a thread about this after the a lot of the rubble cleared and people could see a little more clearly without the fog of war what was actually going on in the order books at that time, because it was widely reported that USDE had depegged. But if you look at what happened across different exchanges, I alluded to that a little bit in my story. What you see is that actually on most venues, USDE was fine. Most venues, USDE did not, quote unquote, depeg. It was really only on Binance that you saw this very massive amount of instability. So what happened was Binance specific. So the question is why? Why did Binance operate in this way? And why were things so weird on Binance? The first thing, of course, was the fact that Binance, because APIs were unstable, things were shut off. That was the period of time during which this quote-unquote depeg took place, was when the APIs were failing. And of course, if you're a high-frequency trading firm, you're a market maker, you're mostly using APIs. You're not pointing and clicking and you're not pressing buttons on the interface. So to the extent that that stuff is turned off, that really meant that a lot of the institutional and market makers, they were just flying blind. They either couldn't do anything or they were just unable to really, like their systems were unable to reconcile the current state of the order book or of their own positions within Binance. So that was one issue, is that just a lot of people took a little bit of time to actually get back online and see what was going on. And once they did, they were able to rectify it and bring USDE back up to $1 where obviously it was supposed to be. There was no point at which USDE was under collateralized. There was no point at which people thought that there were unrealized losses or some other reason to be concerned. Certainly not to the extent of 30% drawdown in the underlying asset. To say nothing of the fact that on other venues, obviously it was trading much higher, and so but you have to have somebody close the ARB. Now, how can you close the ARB? The problem with Binance at that time was that you couldn't get deposits or withdrawals into Binance at that time. So if you sent money into Binance systems were all fucked. And so they couldn't actually recognize that you deposited more money in there or that you'd withdrawn money from there. So what that means is that it's kind of like, it's like they sort of close the door and like throw a tear gas canister in there. And inside of Binance, it's just pandemonium. It's just people coughing and screaming and having a terrible time because nobody can see what's going on. Everybody is flying blind, and nothing can get in or out. Right. Only once that door is opened again, and people can kind of air out what's going on. Market makers can move inventory back in, and they can start to do the peg arbitrage, which is what they need to do in order to get the USDE back to par. That is when you can actually get everything back and working again. Now, interestingly, Bybit also had instability, but Bybit, the depeg took place for about 5 minutes instead of for about an hour, and it went much shallower. It only went to 95 cents before bouncing back. So what was different about Bybit relative to Binance that allowed them to not have anywhere near the extent of issue that Binance had? So there's a few things. First is that on Bybit had integrated peg arbitrage and mint and redeem into Athena directly into the platform. And this is something that Athena mentions in their postmortem, is that they encourage all exchanges that they work with, and most of the exchanges they work with do have this already integrated as part of the Athena integration, to allow market makers to stay on platform and mint and redeem directly. And so normally, if you're in Binance, especially during this pandemonium, if you wanted to do peg arbitrage, you had to redeem, you had to withdraw from Binance, go off chain, go do the peg arbitrage, and then come back onto Binance, right? And if Binance front door is broken and everyone's stuck inside, obviously that's not happening. So there's no ability to do withdrawals or redemptions during that period of time. So that was the first problem. If they had resolved that, it would have looked a lot more like Bybit than it would have looked like Binance. The second issue was the Oracle. So Oracle, obviously, is a crypto native term. Normally, you call it just the index, or what's the price that you're using in order to mark these assets. So Binance, unlike other venues, Binance, to determine the canonical price for liquidation of USDE, they were looking at the price of USDE in their own order book. Now, why is that a mistake? Other exchanges do not do that. Other exchanges don't do that actually for most assets, because if you are, let's say you're some long tail, let's say you're KuCoin, right? If you're KuCoin, you know that you're not the primary venue for almost any asset. Most assets trade way more volume on other venues, like on Binance, than they do on KuCoin. So if you're KuCoin and you see that, like, oh, hey, the price of, let's say the price of Zcash is gotten very low on KuCoin. You don't just say, like, oh, well, great, it's time to liquidate you. You go and look and see, okay, but is KuCoin impaired relative to other venues, and just nobody's come in to arb the prices yet? And that's a common occurrence, especially if there's a flash crash on a single exchange. It might just be somebody swept the order book, price went down a lot, but market makers are going to come in. They're going to smooth out some of that liquidity across different exchanges. But really, you should look at the price on Binance, or look at the price on an average of exchanges weighted by volume, or whatever, this kind of thing, right? This is what you would normally do. Now, Binance, because they're Binance, they don't do that. But not doing that for USDE is a big mistake, because USDE's primary venue is not Binance. USDE was relatively late in getting listed on Binance. Most of the liquidity for USDE was on other venues, and the vast majority of it is in DeFi. So actually, what Binance should have been doing, which is what Bybit does, is to look at other venues and take a weighted average of what is the price of USDE on other venues. And so part of the reason why you saw this reflexive downward spiral on USDE, where it went all the way down to 68 cents, was because people were getting liquidated on Binance who were levered. They were levered on Binance. They were doing this sort of levered looping thing on USDE. Those people were getting liquidated when they should not have, because the value of their collateral had not gone down nearly as much as Binance thought it was, because of the impairment in the Binance order book. So if Binance is liquidating those people, then now they're getting liquidated, their USD is getting sold, and that causes further and further reflexive depression in the price of USDE. So that was the kind of big part of the root cause. And then, of course, USDE is getting liquidated because collateral and other people who have cross-margining, and those cross-margined order books, they get liquidated on whatever position they're taking, and USDE is some of their collateral, and so that USDE gets liquidated as well. So there's a lot of stuff happening at the same time that contributed to this big depeg that you saw in USDE on Binance. Now, all that being said, I think there are relatively straightforward ways that it could have been avoided, but there's almost no way there's not going to be some impairment, right? If you have your exchange unable to take assets in and out, and market makers are unable to see their positions, and the APIs are failing, then almost certainly there's going to be price aberrations, right? So you saw huge, I think Solana had something like $20 difference between Binance and OKX, which, that is insane for an asset that trades as much as Solana. But this kind of thing was just happening on that Friday because of the huge dislocations we saw in the market.
Yeah. So do you think the trigger is more like a set of predefined DeFi liquidation process, or it's like a human emotion? Everyone gets panic. Oh, what happened? Let's run. I don't know what's happening. It seems like on the DEX, this price is okay, but let's not run arbitrage trade. Let's
Yeah.
run.
Yeah, I think it's much more likely that this was systematic. This was a result of liquidations and the inability for market makers to refill their inventory, because somebody has to buy that USDE, right? If it gets liquidated, and if market makers can't get more cash in, they're just like, look, I got to market make all these other books. Like Sol is getting way off the peg. This thing is getting way off the peg. That's getting way not off the peg, but sort of dislocating from other venues. And so there's so much money to be made when you have this kind of systematic dislocation, is that it's like, money raining down from the sky, and the market makers can't pick it all up because they can't get more money into the exchange. So that, I think that's a better explanation of what was happening. If it was really panic about USDE, then it should be happening everywhere, right? If you saw what happened when Circle, so if you remember the USDC depeg that took place during the SVB crisis, right? In that depeg, that was a genuine depeg, right? You saw over the weekend, USDC depeg down to like 88 cents. And what you saw was that it depegged everywhere. It depegged in DeFi, depegged in CeFi, depegged on Curve. No matter where you looked, the price was the same. Everybody was scared, right? That is not what we saw on that Friday. On that Friday, it was that Binance is dislocated, OKX is not, Bybit a little bit, and DeFi not at all. So if there's panic selling, there's no reason why there should be an asymmetry between the people on Binance are panicked, but the people over here are not panicked.
Yeah, okay. So saying like in this scenario, essentially, it has to essentially improve the perp system and the deposit triggering system. Otherwise, there's no way we can get it better. It's pretty much like exactly. Binance at that time is shutting the door that everyone play with their cards inside. They cannot draw new cards anymore.
Exactly. That's a good way to put it.
Yeah. Okay. Next question. Let's basically zoom out a little bit. Essentially on each centralized exchange and of course probably the future of all the perp DEX, there will be like this earn program, right? That's like automatically you have a stablecoin like USDC, USDT that do not generate yield, and you either go DeFi and then stake like the money into USDE as USDE, or you put it onto centralized exchange earn program, where the centralized exchange will have business decisions on how to allocate, and they do not a lot of times let users know, okay, this money goes to this yield-bearing stablecoin, this goes to the other lending protocol and all that. So how do you see the relation between the CEX earn program and the actual yield-bearing stablecoin look like today, and how do you see they should be look like in future?
That's an interesting question. I mean, you see demonstrably a lot of decentralized exchanges do have these earn programs. So Binance recently launched their Ethena-based earn program, and that was one of the reasons why I think you saw a lot of looping and a lot of leverage in the USDE system. That, of course, was part of the reason why the liquidation was so nasty. So I expect those to continue. I don't think those will go away, especially as rates start to go down further. If we get more and more rate cuts on a relative basis, that makes these type of non-treasury linked yield products more attractive and likely to accumulate more assets. So I think the answer is that there's going to be some of both. For the centralized exchanges, these are very turnkey products. They're extremely simple. I think the attractiveness of the crypto native versions, having this be entirely within DeFi, if you're Binance, if you're OKX, if you're Bybit, and you're offering this kind of earn program, you don't really care what it is on the back end. The user doesn't even know what it is on the back end. Oftentimes they don't even want to know. They just are like, hey, as long as the exchange endorses it, I'm okay with this. The advantage of having it be wrapped in sort of this synthetic dollar format is that, one, it's very easy for crypto native traders to move into these assets at times when they want to be delta neutral, but they also want to be earning high yield. So it's a very good form factor. I first think almost like as a file format for yield, as opposed to necessarily that it's all that systematically different from all these other ways that you can be generating yield. But the other thing about it is that it's very easy for fintechs to integrate. So if you're a fintech and you want to say, hey, I already have stablecoin, dollar banking type products, but I want to offer very easy yield to my customers. The easiest way to do that is not to integrate something like Binance Earn. You have to go strike a BG deal. You have to go, get to know Binance and decide whether or not, hey, we're going to integrate this thing and fucks with their APIs and all this stuff. If you just have access to SUSDE, then it's like 10 lines of code. You can just vibe code literally how you create a yield program now for your customers. And so this permissionless integration ability and the form factor that's very easy to understand and very easy to manipulate. Manipulate in the sense of easy to work with as an engineer or as a builder. That I think is the attractiveness of having this in synthetic dollar format. So my answer is I think both of these are going to become quite big. One through the centralized exchange distribution, the second through the long tail and the permissionless innovation distribution of all the fintechs that will integrate this stuff.
Yeah, that's really interesting insight that you were saying this is almost like a file. But I understand that as I also think about this as a form factor, but when you say it's like a file type, it's a really good abstraction of how this looks like. So I guess for people that actually are professional traders and stuff, they kind of understand, okay, here is like a perpetual future and there is like funding rate and people are. But for like retails, what do you think is the right way to tell them, hey, you are earning some risk premium on like this synthetic dollar that is not exactly the same as if you are holding like a treasury backed like stable coin, right? For example, imagine a world where let's say the genius actor is written differently so that USDC has to give its like a short-term 3 months treasury yield to retail. That's kind of a product that you earn the same risk as the treasury bills. But in here, since it's running an arbitrage strategy, it's actually different. And it's actually pretty hard to explain to retail what the tail risk look like. Maybe you can try give a explanation. I think you are investor with Ethena and you understand the space so well.
Yeah, I mean, look, there is no, so I certainly would not consider myself an expert in how to communicate risks to retail. So I'll first caveat that like this is not what I do. But here's the whack I would take at it. So the first thing is that anytime that you're earning above the risk-free rate, it's because you're taking risks. So the question is, what are those risks that you're taking, and is it possible to quantify those risks? In the case of Ethena, it's not straightforward to quantify just because we don't really have that much historical data. And of course, the historical data that we do have is just in a totally different regime because the crypto industry has changed so much post-FTX. And a lot of what makes Ethena have the risk profile it has would not have been possible pre-FTX. So one of the core foundations of Ethena is that it's minimizing the amount of counterparty risk. Normally, if you invest in a hedge fund and that hedge fund is doing the basis trade, that hedge fund is taking a lot of counterparty risk. So one, you're taking counterparty risk with the hedge fund, so that hedge fund manager could run off with your money. But then second, he is taking counterparty risk with the exchanges because he's depositing on Binance, he's depositing on OKX, depositing on Bybit, whatever. Now, what Ethena does is that they use off-exchange custody. And this off-exchange custody makes it such that actually, even if Binance goes bankrupt or they go under, they try to steal all the money, they don't have the money. The custody is not with Binance. It's with, Fireblocks or, whoever, whatever custodian that they're using. And this is one big advantage in the risk profile because before FTX, none of the big exchanges were using off-exchange custody. Not because they couldn't, but because they didn't want to. And after FTX, institutions demanded that if you want us to continue trading on these venues, I never want to have to underwrite another FTX. And so you had better allow me to keep my assets off exchange and settle/clear with you asynchronously. But at rest, the custody sits on Fireblocks or sits on Anchorage or whatever. So that is one of the important things to understand about Ethena is that the counterparty risk is more about the unrealized P&L than it is about the actual collateral. Right, so the assets that are sitting on the exchange cannot be stolen by the exchange if the exchange wants to be a bad dude. But it is the case that if there's some unrealized P&L on a particular exchange, then that P&L could potentially get lost if the exchange goes under. Now that being said, there are ways to solve that by realizing the P&L and basically being continuously doing the work of realizing P&L to keep that unrealized P&L relatively low on different exchanges as you're continuing to do the basis trade. So that's one thing. Second thing, of course, is what happens in a massive market dislocation. So if rates move, if funding rate moves very deeply negative, very rapidly, and this is, of course, because there's a big downturn, then it's possible that you basically get negative P&L because you're not able to, like basically the perps trade at a discount. Actually, that's good for you most of the time when the perps trade at a discount. But the biggest thing is, so of course, one, if you get auto deleveraged, then you can end up getting imbalanced. So you think you're long and short, but actually your short position gets blown out. And now you're just long, and you're long on the way down, and that's bad. So that's one of the risks of something like Athena. Now, there's a rumor that Athena actually has agreements with the exchanges that they do not get auto deleveraged. And it's understandable why that might happen. There's been discussions that many of the big market makers have auto deleveraging agreements with the exchanges such that they do not get auto deleveraged. And the reason why the exchange might be willing to strike that is because these big makers are providing huge amounts of liquidity to the exchange, and they need predictability. They need to be able to know that if I put on a hedge, my hedge is going to stand, and I don't need to worry about, getting blown out of a position on one side or the other. And the exchange is potentially willing to say, look, we get it. We will auto deleverage people who are less systematically important to the exchange. And Athena today is effectively one of the biggest makers for all of these perps products everywhere in the world. Because of the fact that they're providing so much liquidity, right? If you zoom out, you ask the question, why does Athena earn yield by doing the basis trade? Why does the basis trade earn yield? Because fundamentally what's happening is that you're doing this quote unquote trade and you're being paid for it. What is the service you're providing for which you're being paid? The answer is that you are loaning money to the market. That's basically what the basis trade is. The basis trade is people loaning money to the market when traders don't have enough money in the system to be able to fund all of their trades. Right. It basically, there's not enough capital in the crypto industry is what the basis trade is telling you. And by giving that money to the short side of the market, you are funding the people who want to go long and want to take on leverage and trying to go long, which is basically financing. Right. You're financing their investments or their trades. So this trade does sometimes go south. When it does, the way that Athena works is that it will leg out. Like if the basis goes negative, or the funding rate goes negative, then they will leg out of the short side and go into T-bills. That's their general strategy. But it's possible that they don't execute that in time, and it's possible there's some drawdown in the underlying collateral. So there's a lot of things that can go wrong. Now, that being said, we kind of had the perfect case study on what's now we call Black Friday, the 2 Fridays ago, which is we saw what happened when there was a massive liquidation, huge imbalance in the market, massive ADLs, huge dislocations across different venues, perps trading not in line with spot. And what happened with Athena when all was said and done is that actually Athena made money. Athena actually became more collateralized at the end of it because of the fact, of course, that perps, if they end up trading at a discount to spot, then if you're short and long at the same time, you're actually making money. So long story short, Athena actually made money and obviously survived that Friday, which tells you that it's very robust. Now, is it perfectly robust? Is there no circumstance under which Athena would suffer an adverse event? Definitely not the case. There is some series of events that would be so bad that Athena would be impaired. And of course, the impairment is not necessarily a 1 or a 0 or 100, right? If you look at what happened with USDC when the SVB depeg took place, right? USDC did not depeg to 0. It did not go to 0. It did not do what Terra did, right? It went to 88 cents. Now, this was probably foolish for it to go to 88 cents because even if SVB itself were to go under, the recovery on SVB would not be 0. You would get 70 cents on the dollar, at worst, maybe 6 cents on the dollar in a real nightmare scenario, in which case the sort of the NAV of USDC at that time would have been about 95 cents or something like that. But of course there was a panic, right? And so the thing did what the thing did because of market forces. But for something like Athena, the same argument holds true, is that it's not as though if there were some kind of depeg that Athena should go to 0. Or USDE should go to 0. More likely that USDE would depeg to 90 cents, something like this, because they lost a bunch of money because of some structural imbalance or whatever, and that it would have to get recapitalized by doing an equity raise, selling some ENA, similar to what happened with MakerDAO after the COVID crash. Is if you remember at that time, MakerDAO, they ended up having a bunch of bad debt. They did these debt liquidations, didn't go well, and so Maker ended up auctioning off more MKR to fill the hole, raise the cash to recollateralize the MakerDAO system. I suspect that what would happen if Athena were to actually suffer a similar fate is that there would be an equity raise by auctioning off ENA to go recapitalize the system.
I see. Yeah, that's a quite interesting long explanation for the risk. Yeah, actually,
I don't know if that was long-winded, but that's the best I can.
yeah,
I can
yeah, yeah. I think there is one interesting point you mentioned, which is off-exchange custodian service. I think after FTX, people have massive distrust about CEX holding your money, especially as those billion-dollar institution. So there is a bifurcation of approach. One approach is, of course, you were saying the Fireblock Anchorage, where it's more like everything on-chain type spirit. The other is Binance itself also tried to spin off its Binance custody business to kind of like the Seifu, which is like a business that only do one thing, which is like take institutional money and basically be the custodian service for it and charge AUM fee and do no business other than that and have like a complete legal separation from Binance. And a lot of big trading firms these days use Seifu and then they do this Mirror X to basically mirror the asset trading like margins into Binance to run like algo trades. And how do you view the two bifurcation approach?
I mean, I'm very pro. I think that this is a very good step for the industry. I mean, what you see increasingly in crypto is that it's moving more and more toward the kind of market stack you see in traditional finance, where you have less of this vertically integrated, okay, you know, Coinbase does custody and clearing and trading and staking and lending and all this stuff under one roof. You're seeing increasingly not just regulatory separation between the two entities, but also pure business separation, where there's totally different cap tables, totally different entities, totally different licensure, totally different teams. And I think that's pretty healthy. So you're seeing increasingly, you know, like Falcon X, which is the largest PB that exists today, we're investors in Falcon X. They are taking on more and more institutional flows that, as you know, increasingly getting routed to a lot of these exchanges. So you're seeing prime brokerage taking off. You know, Anchorage is also getting more into PB services. You see the same thing with custody. You see the same thing with you know, a lot of the lending and these other services are increasingly getting disentangled from the exchanges themselves. Now the exchanges don't like this per se. They'd rather own the entire stack, obviously. You know, so it's kind of like a bank. Like when you're a bank, you want to have every single thing under one roof, and you want to cross-sell services from, oh, you got me for custody and trading. Well, let me also give you my lending services. Let me also give you my this and my that. So they want to be, you know, one-stop shops. But the fact that they are now disintermediated, I think is good, and that it's a trend that's likely to continue as crypto becomes more and more institutional.
Yeah. But how do you see the like if you were to give safety scores, or I guess like price the tail risk between there are also risk associated with kind of like a Seifu itself blow up. I would say it's like much less risk than Binance itself blow up. In the meantime, you also say like Fireblock or Anchorage can have like some kind of tail events that the money go away. I don't know.
Oh, of course.
How maybe like all there like a massive like hacking events and all that.
Yes.
Like like how
so
do
it is possible that these custodians could get hacked. They could, you know, have some kind of insider attack, whatever. I think at this point, custody is a very, very well resolved problem, especially that these custodians that custody, you know, multi-billion. I think for Coinbase custody must custody in the hundreds of billions at this point. I don't know exactly what their scale is, but Anchorage certainly at least in the tens of billions. So these guys are pros. They've been doing it for a very, very long time. They do it at the highest level of anybody in the world. There is no safer place in the world for your assets to sit but with these custodians. So they are, in a sense, like the quote-unquote risk-free rate. There's nowhere that you have zero risk because there's always some ability to get hacked or something. But if you compare that to self-custody, you compare that to, you know, if you look at the ETF is literally custodied with Coinbase custody. Like everybody at this point is using custodians, or they're self-custodying, or they're custodying directly on an exchange. So those are really your only options. And of those, very clearly the custodians are the safest.
Yeah, totally. Yeah, I guess my question is slightly different to that. Do you see the Seifu or Coinbase custody approach be like have a different risk characteristic from the Fireblocks of the world.
Why would they?
It's just
because Fireblocks is MPC and doesn't have
and also they do not associate themselves natively to exchange, even like in terms of the operating team, right?
Yeah. Sure, yeah. I mean, so I think Fireblocks is probably more risky than Coinbase Custody. I don't know about Seifu, so I candidly I haven't looked very much into the business, so I don't have that much familiarity with how it works or their processes or anything like that. I know Coinbase Custody and Anchorage because we're customers, and we've been customers for a very, very long time. So I know those systems, and BitGo. I know the three of them very well, who are some of the largest custodians. I know Seifu is also very large, but candidly, I don't know that much about it. It's not something that I spend a lot of time worrying about, and I don't think it's worth spending a lot of time worrying about because these are existential level businesses, right? In the sense that not that nothing can go wrong because they're existential, but more that everything that these guys do is oriented around keeping the golden goose alive, which is custody. If custody goes, everything else goes. Nothing else in this industry survives. So the amount of energy and care and thoughtfulness that goes into making sure these custodians are sound is more than pretty much anything else in the industry. So it's something that I candidly do not worry much about.
Yeah, I totally agree. Yeah, the trust level is like so high that I think basically the whole crypto go to mainstream is dependent on these like root constructions, right? If this blow away, then people can only trust like Bitcoin proof of work level like a security, and that basically brings the whole industry.
Even not that. I mean, if the custodians are compromised, then what exactly is the way in which you're going to have access to Bitcoin? You know, are you going to put it on the exchange? Well, the exchange is definitely less secure than the custodians. Are you going to self-custody it? Well, I guarantee you self-custody is riskier than custodying with a third party who's doing like, you know, they're like sharding these things into little pieces, and they have, vaults in like Swiss mountains where they're storing the different things, and people have to get on planes and they know secret code. Like the level of security that actually happens at these custodians is insane relative to anything else. Like this is where the US government custodies their crypto, is with these custodians. They don't custody it themselves because they know they're not as good at it as these custodians are.
Yeah, totally. Yeah. Okay, so let's zoom out a little bit and go back to actually more obvious risk. One thing I mentioned when we start is like for USDE, I think the basis trade itself is at least for me, a pretty well understood risk characteristic. But when you add leveraged looping in DeFi, like Pendle or like all this like places where you can basically circulate and like your USD into it, like makes me scared. So can you explain a little bit like how that goes and what's your view on this setting?
Yeah, I mean, so first I'll say I don't claim to be an expert on these things, but my mental model for like what is fundamentally happening when somebody's leverage looping on something like Athena. So the first thing is that effectively the protocol is financing, whatever protocol is allowing the leverage looping is basically financing you to leverage up on this trade, right? And the degree to which, like your whatever your LTV is for SUSDE, if you're doing this kind of leverage looping, whatever your LTV is ultimately a reflection of what that lender sees as the safety of this trade. So at the end of the day, this is not really up to Athena, it's up to the lender, right? The lender is the one who's deciding the leverage that they're going to offer you to engage into this trade, because they're the ones financing you, right? The depositors in that protocol are the ones financing you, not Athena. So Athena could say, hey, I think this is actually really risky and you shouldn't lever up on it. Doesn't matter, right? It's a free market. People can lever up on whatever it is they want to, so long as the lenders perceive it as being fairly safe. Now what's effectively happening when somebody's levering up on this thing is that they're basically inducing more demand for SUSDE, which is causing more people to mint more SUSD because it's pushing it above the peg, because they're going out and buying more of this asset, which ultimately means that they're just creating more of the basis trade, which pushes down the yield of the basis trade itself, right? And so in principle, it's no different from somebody levering up on USDE as it is for somebody else to come in off the market, let's say some from Neobank, and say, I like the USDE yield, I'm gonna go buy some myself and enter into this trade, right? Both have the effect of lowering the marginal yield on USDE and basically adding another dollar into the basis trade and further saturating the market. So USDE has this effect that it's a little bit like it's a little bit of a rubber band in that as more and more, as the trade gets more crowded, the yield goes down and the demand for increasing the size of USDE decreases, right? And so the increased risk that the looper is taking is the risk to the looper, right? And the risk to the lender mostly is that obviously the lender can end up making a bad loan. But the risk to the looper is that the looper can get liquidated if there's a temporary depeg in USDE or a long-term depeg in USDE, right? They're taking on that risk. But the effect to Athena, I don't think is actually that significant because the people who have the yield that they're getting through neobanks, so the people who just want the yield, right? Let's say the yield goes from 8% down to 4%, right? So now it's basically at the risk-free rate. Well, if the risk is pushed down to the risk-free rate, then the person who's just in that neobank is like, wait, why am I doing this? I don't want this yet anymore. This is a crappy yield product. I'm going to go back to treasuries, and so they're going to sell their USDE, and you're basically going to get a risk transfer from the loopers, from the people who are getting it organically from the yield to the loopers, and the loopers might eventually become 100% of the people who own USDE because they have these very low LTV ratio or very attractive LTV ratios that are making it attractive for them to do this looping. But the people who just organically want the yield are like, hey, this yield is actually not that attractive for me. So I think the markets more or less equilibrate. Now, it can lead to unwinds, right? So this is the big issue with having too much of the supply in these loops is that the unwinds get really ugly. But again, who absorbs the cost of that unwind? The answer is the people who are leveraged, the people who are doing this crazy trade, right? If you are not in the group of people who are facing this massive unwind, like USDE itself is not going to tank the value of the underlying collateral. The underlying collateral does not care what's happening on chain. If the things on chain are going topsy-turvy and there's crazy liquidations and somebody levers up and there's a temporary depeg and da-da-da, like you see what happened 2 Fridays ago, the value of the underlying collateral, it's immaterial to what's happening on chain. The same thing was true of Circle, right? If you look at Circle, the fact that USDC went down to 88 cents had no bearing on the value of the collateral that was sitting in SVB or sitting in any of the banks, right? No effect, which is what you want to see, right? Now, this is not true for Maker. It's also not true for it was not true for Terra, but for USDE and for fiat collateral stablecoins, it's just not true that it really matters what's happening among the leveraged loopers relative to the actual collateral and the backing of the stable or the synthetic dollar itself. So that's why it's something I don't worry about so much from the perspective of the stabilization of Athena. It may mean that there's more demand and the supply of Athena gets too big. But if it gets too big, then ultimately what you're going to see is that there's almost all the supply is held by loopers, and none of the supply is held by organic, demand for high yield. That's what it'll end up looking like if the system becomes too saturated among loopers.
Yeah, I agree with the mechanics, but I think in my mind, first of all, for funding rate to be like pushed towards the level of treasury yield, I don't see it happening unless crypto is like completely unregularized to the point like the BlackRocks of the world can deposit money into this basis trade, right? Otherwise, I don't quite see it. Like I think it's just somehow there's a native.
There are times. No. There are times when the basis trade turns negative, right? So obviously, there are times when that yield goes below the risk-free rate. And in the past, the way Athena worked is that Athena would just still stay in the trade, even if the yield was below to the treasury yield. Now, recently, I think I can't remember how long ago but this wasn't that long ago that Athena made this change. Is that they decided that hey, technically this is a more elegant product if it just captures what is the funding rate and what is the basis trade yield. But they realized that people don't want that. People are lazy. They don't want to like move in and out of USDE into USDTB, which is the stablecoin by Athena that just has BlackRock treasuries behind it. People want you to just do this for them. And so Athena realized that, okay, actually what people really want is for us to just move into T-bills when the risk-free rate is higher than the basis trade yield. And so they just do that now because people are lazy and they just want that to be the product. And they want the USDE supply to be more stable. And so that's what they do now. But so because of that, but the answer is that no, this actually happens routinely, is that the rate of that you're getting paid doing the basis trade turns negative or turns below 4%, in which case now what they do is they just move out of the basis trade.
Yeah. Yeah. Another thing I think is quite interesting from your description is like, from mathematical mechanics, it's equivalent that loopers are the same as people who deposit into neobanks. But I think in terms of like real, like execution, I feel like on-chain loopers are people that just going after just a slightly higher yield, and they cannot even understand what type of risk they are taking. They just press a button and want more yield. And in the case of neobanks, it's normally like it's more Web2 consumers, and the neobank themselves are sitting in the middle to like look at the risk and actually control some of it. So the process of like this crazy acceleration of like just getting double the yield is like much mild. So I feel like there's quite different form factor.
Even if let's say that USDE was completely in T-bills, like let's say the basis trade, the whole market wants to be short. As a result, basis trade isn't paying anything, and so USDE moves entirely into T-bills, right? Now, in this world where USDE is paying, whatever 4% minus epsilon, that it will likely still be the case that the loopers are still looping, right? The loopers don't care because net of all the looping, they're making still better than the T-bill rate, and so I think that's not unreasonable. Is that if this becomes the most liquid vehicle through which you can underwrite making even a trade in treasuries, right? So the question is, okay, now you have people leverage looping in treasuries. Is this risky? Is this, the arguments that you are making, are these risks also apply to the treasury market? Well, okay, people obviously do lever up on bond yields. They've been doing that since forever. Is it risky? Yes, it's not riskless, obviously. I mean, if you saw what SVB did, SVB was basically levered on bond yields, right? And they ended up going under and having to get bailed out by the government. So the answer is, of course it's risky. Of course it's risky. And the risk appetite of a leveraged looper is very different than the risk appetite of somebody coming in from a neobank. But I think that's okay. Is that in and of itself a risk to Athena? I think, it's not riskless, but is the risk one that Athena cannot bear, or that would make you want to avoid something like Athena? I don't think that's obviously the case. I think it just means that the risk profile or the risk appetite of the people who are holding this asset is very different than it would otherwise be. The composition of risk appetite changes among the holders.
Yeah, totally. Okay. Yeah, this brings up to a very interesting question, right? The underlying asset is pretty much in your mind, not impacted by the front end. It's like there is a front end and back end separation of asset. Right.
That's right.
Okay. So let's discuss the backend, right? Like I think Ethena has this major innovation that put like basis trade, the funding rate arb strategies P&L as basically an equivalent of some kind of money market fund, right? So that people can like easily access it and essentially turn a traditional institutional hedge fund product into something that retails can get access to very easily, as you were saying, a file format. What do you see as the other strategies, right? In my mind, as a pure kind of hedge fund guy, it seems any strategy that don't have daily drawdown, or probably like even in the extreme case, weekly drawdowns, can be turned into some type of like synthetic dollar style product, right? Like it don't necessarily need to be funding rate arb trade. It can be like collecting the market making fees. It can be something even like if you can figure out a way to make some of the private credit market super like liquid, which is like a small corner case, like uses collect a small group of lending club loans from like a PIMCO. Potentially something like that can be turned into a fraction of the asset for like a stablecoin yield bearing product. So what's your view? Like where do you put the separation? Some is like hedge fund, you need a credit investor. Some is like on-chain, anyone with $100 can deposit and generate yield with.
Yeah. So it's a good question because I think there's a spectrum of strategies. I think it's not about max drawdown. Actually, I think that's a wrong framing. I think it's much more about first, are you delta neutral? And not all strategies are delta neutral. And obviously some strategies are delta neutral-ish. So something like market making is delta neutral-ish, but it's not actually delta neutral, right? Because you are, taking directional risk on some asset and you're trying not to take too much, but normal market making requires you to take some amount of directional risk. So it's if you have positive P&L or negative P&L because of the underlying, that's normal. That's not like, oh, you're a bad market maker. So I don't think market making is a great example of this. Even things like risk parity, right, which is trying to be delta neutral-ish, but like these kind, or like stat arb type strategies, they're sort of delta neutral-ish. I think these are statistically delta neutral, but they're not strictly delta neutral, right? And so as a result, there really is not a strong guarantee that you can give on the strategy that it's going to maintain. It's not going to break the buck. It's actually very normal for a stat arb type strategy to quote unquote break the buck if the market is trending in a certain direction. It's like, hey, we're delta neutral-ish, but it's not crazy that we might have a drawdown during this period of time. The second thing is the forecastability of the yield, right? So take a pure arbitrage strategy, like not stat arb, but actual arb. If you are doing an actual arbitrage strategy, that's delta neutral, right? Actually delta neutral, should not be taking any directional risk, shouldn't matter what's happening in the underlying, but the earnings are unpredictable. Could go a long period of time where there's basically no arb, or you have a huge amount of arbs on one day and then no arb the next day. So your ability to forecast the yield that you're going to earn in the future is just not really there for an arb strategy. So unless, I don't know, maybe I don't know this market very well, but my assumption is that it depends on dislocations in the market and the volatility of the underlying, and it's just not, again, there's not as much historical reliable data for pure arbitrage. So I think that's one of the reasons why the basis trade is so uniquely well suited to this. It has all these properties that are exactly what you want for this kind of trade to get tokenized and turned into a synthetic dollar. I think there are very few other strategies that have those properties. There's some that are close-ish. Like there's a bunch of people trying to do private credit type things. I think private credit is maybe the closest, but of course, like there is, if you have a private credit strategy and there's a default on a loan.
It's a liquidity, right? Yeah.
Yeah, exactly. It's like it's not as though like loans are never supposed to go bad. They are supposed to go bad sometimes. Like that's why you're getting paid 17% on a private credit strategy is not crazy, because obviously there's a lot of risk there. So that's why I don't know that there are that many other examples of markets that are good candidates for this. I think carry trades are really the best example, and there aren't that many really well understood, well-founded carry trades with big capacity and a lot of yield. Maybe like the yen carry trade is the best example. So if somebody were to do a synthetic dollar for the yen carry trade, I think that'd be very interesting. But then what's the risk you're taking? The yen, which is, it's a weird risk to take, but if the yen versus dollar moves in a certain way, you can end up breaking the buck.
Yeah, I thought about exactly that last year when there is the unwind of the yen carry trade, when the Japan central bank did the first time of change their policy, right? It seems to create a massive kind of shock to the market for almost 3-4 days, right? Like everything, including Nvidia, a very solid asset that had nothing to do with it, was going down.
That's right.
Through
the
this
yen carry trade is not delta neutral, right? You're taking some risk in the pair.
Yeah. In crypto, in some sense, there's no central bank, so that there is no somehow this kind of unpredictable event risk that some guy decided let's change our gears, right? But it's still retail sentiment kind of doing.
Yeah, I think people. It is obviously true that there's no central bank. There's nobody's going to bail you out. But then at the same time, Binance just sent out $700 million to quote unquote bail people out. So is there no central bank? I don't know. Maybe Binance is a central bank.
That's interesting. Yeah, Binance is central bank on their own ecosystem, right? But it's not really a central bank that kind of covers the whole industry. If you lose money on DEX, no one take care of you. Yeah, but the market is intrinsically connected to the point that, everything is coupled.
There's obviously not a central bank, but there actually is more insurance than it seems at first glance. You might think oh man, if something goes wrong, I'm screwed. And the answer is actually not really, right? Like most protocols, if you get hacked, or if the protocol gets hacked, very often they'll make you whole. If an exchange gets hacked, they'll make you whole. If an exchange has some screw up in the oracles, there's some weird price dislocation, they'll often make you whole. So there's a lot of secret insurance that's peppered throughout the industry. That's not it's not legible, but it's still there.
Yeah, totally. Yeah. I guess the last thing is we all saw the tokenized stock wave, right? It's moving away from yield bearing stablecoin, but it's kind of similar spirit where you take very liquid product of course, it's trading like 5 days a week with kind of some of the good exchange venues. You can pretty much trade 24 hours within the weekdays, right? If on Robinhood, on good like pairs like Nvidia, you can pretty much trade 24 hours for 5 days. But there is a push towards, okay, let's put stock like 7 days, 24 hour, and let's make it tokenized. I think like X stock is trying it with Solana from Kraken, from like Robert is good friend of yours. And also there is like Robinhood CEO publicly saying in Europe that we're gonna do like a tokenized stock that allows people to take their like tokenized Nvidia back to their wallet if you are in Europe, you're not subject to US regulation. How do you see that move happen? Today, there's not much liquidity, right? If you go to Solana and try to trade an Nvidia X, you realize the curve look like boom, 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 like this, right? It's not like a smooth price curve.
Yeah, that's right.
Yeah, how do you see that movement?
Yeah, I'm pretty skeptical in the short term about these tokenized stock platforms. The reality is that they're just not good products, right? Like they're extremely low liquidity on the weekends or in the evenings when the stocks aren't trading, and there's no reference futures market. If the futures are trading, then it's fine. But if there's no other price discovery, then liquidity just dries up. People have bad experiences. If you look at X stocks right now, it's not doing a lot of volume. I think it's a market that's going to take a long time to get off the ground, because the reality is that there's not that many people who live on chain today who are that interested in trading single name stocks. There are people who are interested increasingly in there's a broader story of what's going on about macro, what's going on with gold. You see some platforms that are starting to increase their trading of these assets, but it's mostly derivatives that are getting all the volume. It's not spot. So if you're getting spot on individual assets, like, do you really care whether or not your exposure to Tesla is a tokenized stock as opposed to a derivative? Not really. Especially if you have to deal with dividends and all this other stuff. Like, for the most part, people just want to trade a perp. They want to get leverage. They want to do it quickly. And they still have the same problems with the weekend liquidity and the price discovery. But I think that's where you're seeing almost all the growth, is not in these tokenized stocks, but rather in the sort of derivatives on RWAs.
Yeah, so saying like potentially the best product will be like 100x perp on Tesla stock over the weekend, and we just figure out how to price discover. Like Blue Ocean will probably extend the liquidity.
Yeah, so I think it's pretty obvious that you're not going to be able to get 100x leverage on a weekend, right? Because how exactly are you going to liquidate somebody at 100x leverage? And the reality, of course, is also people don't trade with 100x leverage. That's kind of a meme. Although they advertise these things, vast majority of people are trading, if they're trading with leverage at all, they're trading with 2 to 3x leverage is the most common.
Yeah.
So I don't think that's why people are trading these things. I think it's just easier. It's easier, simpler, and the inventory problems are not as severe as okay, how do you get all the Tesla stock where people want it? When it's derivative, it's just a lot easier to scale it up and down depending on demand. So it's a lot closer to the CFD market than it is to people actually trying to deal with a brokerage and get Tesla stock from anywhere in the world. So I just think the market structure is gonna favor the derivatives rather than the actual underlying stocks.
Yeah, assuming no regulation, right? Since this is a even tougher regulation to push through than have spot like Tesla deposit somewhere.
Is that they're going to be non-US markets, right? So the reality is, if you're in the US, just use Robinhood. Like, why do you need any of this stuff? So for domestic use cases, I don't think there's going to be a lot of demand anyway, because the substitutes are already very good. It's internationally overwhelmingly where people want this stuff and are willing to go on DeFi to get it. So that's where I suspect that the demand is going to come from.
Yeah. And I guess one following question is why options never took off. Like in Robinhood, you see there's humongous trading traffic on this single stock options, and that's kind of a lot of the retails play as their bread and butter. But in crypto, maybe because of the existence of perp, somehow option never really took off. But do you see in the future when when we have perp futures on all the single name stocks on gold, there will also be a lot of options? How do you foresee liquidity structure?
No. I think it's getting the causal story for options totally wrong. The reason why options are so popular in Robinhood is obviously because of the fact that you can get massive leverage, and leverage, just getting leverage on spot or getting leverage on futures or whatever, it was banned in the U.S. for retail investors. So it's a synthetic way to get exposure. Obviously, with options, it's not hard to police, but it's at least plausible deniability in that policing is saying they're like, oh, well, these guys are just, they click the button saying that they're intelligent investors and they want to express this very complicated, they're like you're looking at the strike price and the time to expiry and all this stuff. Like there's a lot of variables, and having, I think probably what will end up happening at some point is either it becomes enough of a social problem that people start regulating options, or that there's just a YOLO kind of like, hey, whatever, let's just deregulate all of it and allow people to gamble if they want to gamble. I mean, that's certainly what we've done with sports, and just say like, hey, why not you can go long futures, or you can go just buy the stuff on margin and just like lever up like crazy on Tesla stock over the next 6 hours. And if you allow that, people will stop trading options tomorrow, because options are just a really weird product and very difficult for retail to understand. And it's a lot easier to just jam the 10x or 100x leverage. So it's a much simpler to understand product. That's why it's superior in crypto and DeFi. Options normally, the reason why options are as attractive as they are as a product is because they allow you to hedge. And they allow you to express hedges very effectively. Crypto doesn't really have hedging. The only real people who are hedging are miners, and that's not that much flow. So because of that, options have never really taken off in crypto, and I don't expect them to.
I see. That's a great explanation. Yeah. Okay. Yes. Thanks so much. I think the last question we have, which is a transition, is kind of predicting the future, and have like anti-consensus contrarian predictions. So normally we ask people to predict things around AI, but this time, since we go so deep, like I will ask a harder question. How do you foresee the whole like yield-bearing stablecoin and the perp DEX ecosystem evolve after we have like AI being so like powerful, as like a lot of people nowadays are using ChatGPT that are also trading on Binance, trading on Hyperliquid, and we see like people are creating like AI competitions, so like different large language model trading on like Hyperliquid to compete, right? Let's predict like 2 years from now. How do you see the landscape look like? How do people interact with their wallets? How do people interact with like on-chain DEX versus CEX?
So I suspect actually that, so a few things. So one is that people are going to be interacting with their wallets much more in natural language than they are going to be pointing and clicking on things. And so I think there is going to be a lot more wallet automation, where your wallet is basically your financial advisor. They're preventing you from making mistakes. They're constantly doing research on everything you interact with. And they're making sure that the protocols that you use are safe, that they're not being attacked, that there's no DNS spoofing, there's no, they check the Twitter, make sure that, there's no warnings being given at any given time. They look at the overall health of the project. They look at the smart contracts. All of this stuff will be happening in the background anytime you want to use a product. Now, what about for trading itself? I suspect that there's going to be 2 different modes. So one mode is going to be that if you actually want to just rebalance your portfolio, then you'll just tell the AI will do it, and it'll automatically do a TWAP, it'll do smart price execution, it'll hide your trades, it'll do all the smart stuff for you that you would otherwise want to do yourself. So that will just happen for you. For people who are trading, I suspect that actually trading will still continue to be point and click based. Now, why do I say that? The reason why I say that is that I think what most people are doing when they're trading is they are simulating a game, and the game that they're simulating is that they are a professional trader and that they are, a sharp. And the way that you simulate this game is by, the way the game is fun is by you looking at the chart, you drawing the little lines, you doing the little analysis, you being in your little Telegram chat with your friends, talking about I think that this thing's about to happen, it's about to break out, it's about to do this. And if you had an AI doing it for you, it would take all the fun out of the game. It would almost be like, getting an AI to automate pulling a slot machine for you. That actually is not, the gamblers are not going to do that. They're not going to get an AI to simulate pulling a slot machine, because that's the reason why they're there. The reason why they're there is to have the fun of pulling the thing on the slot machine. So I actually think that's not going to get automated. Now, maybe some of the analysis will get automated. They'll ask the AI, hey, what should I buy today? Can you draw me some lines? And I was like, oh, da, da, da. But I was like, oh, but what about this thing? Don't you think this thing is about to do a blah, blah, blah? And the AI will say, oh, yeah, that's a great point. Here, let me draw that on the line for you. I think that's what it's going to increasingly look like. AI will be a participant in the game, but the game of trading is going to continue unabated, because it's a very, very high product market fit game. People like to feel some agency and some connection to the world of what's going on in the broader market. That's why they day trade.
Oh, that's so interesting. Actually, yeah, we have such similar views on like how product should look like. That I build this like wealth manager AI that basically allows you to do basic things across different chains that you don't need to worry about. Oh, I don't have gas fee on this chain and blah blah blah. But in the meantime, like personally, I built a system for myself over the last year. Actually, on my Roth IRA account on Robinhood, I'm like 800% up. Just like
Congrats.
yeah, like AI basically replaced all my old days of like analysts who do fundamental analysis, who understand news, who like do all that. So basically, I am still the PM. I have like AI being my analyst, and slowly I'm having AI to also be my execution trader that execute my views. But still, I'm the person who synthesizes the final like stock recommendation, the reason why I should long or short, and I use my kind of future predictive ability of like how, for example, like OpenAI or maybe like have relation with the next hyperscaler or OpenAI will like give another deal to Intel, stuff like this to like judge, okay, should I participate in the game? So for me, like stock trading is kind of the game you were saying, trading, and I find the AI is still super helpful to help me at least automate all the need to like build up a team, hiring smart young person that go search internet, write me reports, and potentially next step is also automate those quant developers that turn my languages of like, oh, I want to build this tool into reality. So I think that alone is a very big transformative force to essentially allow everyone to be like a big buy-side PM that have like a 10-20 people team.
Yes and no. I mean, I think for somebody like yourself, there's an interstitial phase that we're in right now, where somebody like yourself who actually has the ability to play PM can do that and actually earn some significant P&L by doing this fundamental analysis type stuff. Give it, call it 5 to 10 years, or maybe 10, let's say 10, just to be safe. In 10 years, the AI is going to be better than the PM, right? Like the AI is going to be better than you at playing PM and sitting at the top of the stack of the other AIs. But not only that, but if you run that system locally and you have your own little PM entire stack running on your behalf, it's going to have zero alpha. All of the alpha is going to be drained out of the system by professional hedge fund managers who have the lowest latency advantage, who already have hundreds of thousands of instances of all of these, PM stacks, whatever is the optimal allocation of, 10 AIs to be coming up with a, little pod essentially that's running their own strategies. And all of these are going to be running in a data center co-located with NYSE and with NASDAQ. And they're going to be running all the time, 24/7, coming up with trade ideas, seeing if they work. And as a result, anything that your AIs would come up with, even if they're correct, the latency disadvantage is going to mean that there's no alpha in your AI system. But there's probably another, call it 10 years before all of that gets drained out. So at least from now until the next 10 years, there's certainly a lot of alpha to be made from somebody who's as sophisticated as yourself, building and deploying those AI systems and using them to make money.
Yeah, I specifically designed my system so that it trades a Roth IRA account on Robinhood. So I have literally negative advantage, since Citadel Security will probably pick up some of my trades and kind of believe this is like a mobile guy that is trading on their phone. It must be stupid. And also I have zero latency advantage. I cannot even have my algo to execute the views for me. I try to restrain it, like, oh, I wake up, I take a look at what AI pushes to me as opportunity. And then just click trade. I just do that experiment for a year and I got it like 100. I think it's kind of doable just by AI doing some of the basic fundamental analysis. Of course, I would love to have like an execution trader that, like when Trump announced on like Truth Social, it do not even do anything else. It's just like, okay, Trump is the oracle. When Trump says this and it's the president, let's just liquidate all your portfolio at once. It's like a pretty powerful risk control tool that needs to be automated.
That's right.
Yeah. So with that, thanks so much for attending this, and let's hope in the future we have like AI and the whole crypto being mainstream, being like two of the biggest force, and potentially we see a very different world from today, where like a TradFi, CEX, and DEX will be like one giant ocean of liquidity that everyone plays in, and maybe people still have their like little casino fun in this game, even if AGI are so smart that you cannot. Maybe in the future we'll have like a game like poker that will ban all the algo players. It's like it's just the people versus people. That's still like a synthetic like perps in this little corner that everyone needs to sit in the room and cannot use to help them analyze anything.
That would be interesting.
Right. Poker already like this, right?
Yeah,
you are a professional poker player, and you probably cannot beat the best AI today that does not even use maybe like counterfactual regret minimization, just like generic GPT-5. I don't know if they can beat you, but if you talk to Norm Brown,
I would get GPT-5 probably not, but it's true in chess already, right? Chess is already way past that chasm many years ago. So we have a preview of what it looks like when a game crosses to the point where the only reason why this game exists is for humans to play humans. We don't really care about whether humans can beat AIs because we already know they can't, more than 10 years ago.
Yeah. That's interesting. Yeah. Let's see how that word comes. Yeah.
That's right.
Cool.
Anyway, Bill, thank you for having me. This is a lot of fun.
Yeah. Thanks so much, Haseeb. Yeah. Bye, everyone. Thanks for attending.